Hi guys, and welcome to week 4 here for our governmental accounting course. This week here in week 4, we're talking about business type activities as well as fiduciary activities. So here we're going to talk a lot about business type activities, really focus on things like utilities. And so we're talking about natural gas here. We're also talking about like water services. In the fiduciary realm, we're talking a little bit about investments and those types of things. So let's just kind of jump into a couple of the kind of big ticket items here for week 4. So to start off with, our business type activities. Here we're talking about enterprise funds, internal service funds. So enterprise funds really used to account for activities, as the book describes, that produce goods or services to be sold to the general public. So we're talking about more like sale activities. So these are things, a government agency, a government body has, kind of the common good, right? The common, they're providing services to citizens regardless. So it's the property taxes that are helping fund those general services, if you will, which is where we spent a lot of the time so far this semester or throughout this course so far. But here we're talking about more like exchange transactions. So use water, pay a fee. Use electricity, pay a fee. Use natural gas, some other type of utility, pay some sort of fee. And so that's really where that enterprise fund, or as it's sometimes referred to as business type activity, because now they're not just providing some type of service to the community or to the population at large, but more on an exchange transaction type of a basis, like a business, right? So that's where that kind of comes from. So within those enterprise funds, again, a lot of the focus is the most traditional ways that a government would participate in those enterprise activities is through utilities, often water, often natural gas, often electric, those sorts of things. Within the statement of net asset position, I just wanted to spend a second here on this breakout in the net position. So in the chapter, you'll see some illustrative financial statements that are going to talk about net investment in capital assets, restricted net assets for debt service, as well as unrestricted. So these are 3 very distinct, purposeful delineations and categories within our net position. So in a traditional business, right, when we're talking about FASB versus GASB, so in a for-profit company here, we're talking about retained earnings, right, partner capital, those sorts of things. Here in the government role, we're talking about net position. More specifically, in the business type activities, we're talking about investment, net investment in capital assets. So what do we have invested in those capital assets? Restricted for debt service. So we have some position, we have some equity built up within this activity, but it's restricted, okay? We know we're going to have some debt service payments, and so those assets are in essence restricted for a specific designated purpose, in this case for debt service. And then there's the unrestricted category. So that's, as the name implies, it's unrestricted. That business type activity, that enterprise fund can, not quite, we still got to follow laws and rules and that sort of thing, but it's unrestricted. So they can do with it as they see fit. So build up some unrestricted assets here in their net position. They can use that for making additional investments, upgrades to systems, employee bonuses, incentives, those sorts of things. So it's important to note that difference, though, that we do have some restricted some of those assets that we have to use for specific purposes. Okay. So then switching over to the fiduciary activities, the book kind of talks about the three big things to get started with. The assets are basically controlled by the government, so they can make decisions regarding where those assets are placed. So investment decisions, the investment advisor that's being used, the care and custody and control of those assets is all there in that government agency or government body. The assets were not generated by the government's exchange or non-exchange revenue. So they're not really their assets, right? They haven't participated in transactions that created those assets, but instead they're the assets of others, right? So that's where that fiduciary agency principal relationship starts to get established. And then the third element is that the government does not benefit from the assets. So if those, even though they're controlled by the government or that government body, okay, let's say they invest them in some sort of stock, okay, that stock does really well. The government isn't going to participate in those capital gains or dividends or whatever those investment outcomes are. There's no benefit to the government for holding those assets. Okay. So a couple of custodial funds. So custodian, in the care of. Okay. That's what we're after here. So tax custodial funds. The idea here is that I don't know if any of you own any real estate versus rent. But if you were to own some real estate, what happens is that, like my wife and I, we own our house. It happens to be just outside the city of Tiffin in a small township. And so when the property taxes for our house are paid, it goes to the county, okay, Seneca County, okay. But part of those taxes are for the benefit of the township, for the library, for the public school in Tiffin. Okay, so there's a lot of other parties that are involved that are ultimately going to be beneficiaries, if you will, of the receipt of those property taxes for our property, for our house. Okay, so our property taxes get paid to Seneca County, along with our neighbor, along with our other neighbor, and all the people in our township, all the people in Seneca County, okay? And so Seneca County is a tax custodian for those funds. They're going to gather all those tax payments, and then they're going to ship those dollars out to the library, to the school, to the state of Ohio, to the city of Tiffin, wherever those funds need to be, in essence, distributed. So the custodial is almost, kind of like a collecting basket, that then those funds get flushed out to those specific parties. So fiduciary there is basically that they're being held, but just for a short period, and then it's just kind of like a clearinghouse in essence, almost. Okay, and then pass through custodial funds. So that's a situation where a lot of times with grants from different agencies or different bodies, okay, they might have a primary grant recipient, okay, and so that's the entity that the funds are going to be distributed to for this specific grant. And so, but then maybe that, so even like Tiffin University, okay, or let's say the Seneca County Health Department, okay, so maybe they received some funds, the Seneca County Health Department, related around COVID, right? and then that health department then distributes those funds to maybe Tiffin University and the public schools here in Tiffin, Ohio, as well as other agencies, groups around. Okay, so that's a custodial pass through for that Seneca County Health Department, let's say. Okay, so that's part of the dynamic that can come into play there. Okay, and then when we're talking about investment trust funds, there we're talking about pooled assets. So there we're talking about where there's a situation where maybe 2 or 3 small townships pool their funds together, and maybe those funds are invested at kind of a higher aggregated level. So those pooled assets, that's what that's all about. It's just kind of working together, bigger pot, maybe a better return, maybe more buying power within those investment categories, maybe reduced fees, maybe better returns, those sorts of things. The other aspect that we see here is 2 different types of benefits, a pension plan. So we have defined benefit pension plans as well as defined contribution. So whether or not the government is required to contribute so much, so that's more like a 403b, or what in industry we call a 401k, right? So if you put in money, they put in money, so the contribution is defined. Okay, the defined benefit is that when you retire, you get 60% of your compensation, let's say. And so in either case, there's a fiduciary account, a fiduciary fund where those assets are being invested. But remember, those assets might be under the control of the government, that government body, but the benefit is there for the employees, or retired employees, still working employees, okay, future retirees. And so that's the orientation for those 2 different types of pension plans or pension funds is really about how is the money being sourced? How does that work? Is it for the benefit? Do you get a benefit? Is that what's defined, or is it that your contributions are defined? But ultimately, there's those assets being held, stocks, bonds, mutual funds, those sorts of things, for the benefit of others, back to that fiduciary, that principal agency relationship. So hopefully that sheds a little bit of light on some of the kind of the bigger, kind of new, different, unique areas within this week's content. So again, feel free, let me know what kind of questions you guys are having. Make sure you get after the assignments as well as Smithville case. Okay, City of Smithville takes a lot of time. I'd encourage you to get in there and start working on that as soon as possible, and continue to work on it as we go through these chapters, because it's this activity that we're talking about right now that you're going to need to be working on through that case. So look forward to talking to you soon. Take care. All the best. Have a great day.